In the late 1990s, Enron was a titan. Headquartered in Houston, Texas, it soared to become the seventh largest company in America, lauded by Fortune magazine as America's most innovative company for 6 consecutive years. Its executives were seen as visionary, its stock price seemingly unstoppable. With a market capitalization reaching an astounding $74 billion, Enron embodied the promise of the new economy, a diversified energy company, pioneering in natural gas and electricity trading, expanding into broadband, and even weather derivatives. It was a Wall Street darling, the envy of the corporate world, until the cracks began to show. Enron's ascent began with the deregulation of the energy markets in the 1980s and 90s. This created a new frontier for commodity trading, and Enron was at the forefront. They bought and sold natural gas and electricity contracts, acting as a middleman, but doing so with unprecedented scale and sophistication. Under the leadership of founders Kenneth Lay and later CEO Jeffrey Skilling, Enron transformed from a traditional pipeline company into a complex financial services firm, betting on future energy prices and building an empire on the ethereal promise of tomorrow's profits. A critical innovation, or perhaps a fateful one, in Enron's financial strategy was its embrace of mark-to-market accounting. Approved by the SEC for specific energy derivatives in 1992, this method allowed Enron to book potential future profits from long-term contracts immediately on its income statements. Instead of recognizing revenue over the contract's life, Enron could estimate the present value of all future cash flows, declare it as current income, and present a picture of robust, consistent profitability. On paper, it looked like genius, but it relied heavily on subjective estimations. Mark-to-market accounting, while legitimate in certain contexts, became Enron's greatest vulnerability. For liquid assets like stocks, market value is clear. But Enron's long-term energy contracts, often spanning decades and involving unique assets like power plants or internet bandwidth, had no readily available market price. Enron's accounting essentially required them to predict the future. What would energy prices be in 10 or 20 years? These projections were often optimistic, self-serving, and, crucially, unaudited in their underlying assumptions. If a project soured, they couldn't simply undo the profit they'd already booked. As Enron expanded rapidly, its debt began to accumulate at an alarming rate. This is where Chief Financial Officer Andrew Fastow entered the picture as the architect of a more sinister scheme. Fastow pioneered the extensive use of special-purpose entities, or SPEs, intricate financial structures designed to offload risk and debt from Enron's balance sheet. These entities, often bearing bizarre names like LJM1, LJM2, and Raptor, would become the primary mechanism through which Enron obscured its true financial health, creating a deceptive facade for investors and regulators. An SPE is a legal entity, often a limited partnership, created for a specific purpose. In theory, SPEs can be legitimate tools for financing projects or isolating risk. However, Enron's SPEs were anything but standard. The core deception was that these entities were supposedly independent from Enron, meaning their debt and losses didn't have to appear on Enron's consolidated financial statements. Yet, Enron often guaranteed the SPE's debt, and in many cases, senior Enron executives, including Fastow himself, held personal financial stakes in them. It was a convoluted system designed to transfer financial liabilities off the books. With mark-to-market accounting overstating future profits and SPEs concealing present debts, Enron presented an incredibly deceptive financial picture. When an Enron project lost money, the loss was transferred to an SPE, disappearing from Enron's official statements. But to make these transfers legitimate, Enron needed to receive something in return, usually its own stock, or promises of future equity. This circular arrangement created a continuous need for Enron to maintain a high stock price, as its financial wizardry depended on the perception of sustained growth and value. None of Enron's elaborate schemes could have succeeded without the explicit cooperation, or at least, negligent approval of its auditor, Arthur Andersen. One of the Big Five accounting firms, Andersen was not merely an auditor, it also provided extensive consulting services to Enron, creating a severe conflict of interest. Andersen reportedly earned over $50 million annually from Enron, blurring the lines between oversight and advocacy. Their failure to challenge Enron's aggressive accounting practices and the eventual destruction of crucial documents would ultimately lead to their own downfall. Despite the meticulously crafted illusion, subtle warning signs began to emerge. Some analysts struggled to understand Enron's opaque financial statements, often finding it impossible to reconcile reported earnings with actual cash flow. The company's financial reports became increasingly complex, filled with footnotes detailing hundreds of special-purpose entities, each an opaque black box. Whispers about questionable accounting practices started circulating, but Enron's reputation and powerful connections often silenced critics, portraying them as simply not understanding innovative finance. In August 2001, a crucial internal warning surfaced. Sharon Watkins, an Enron vice president, wrote a memo to CEO Kenneth Lay expressing deep concerns about the company's accounting practices. She warned that Enron could implode in a wave of accounting scandals. Watkins highlighted the improper use of SPEs and the questionable mark-to-market valuations, essentially detailing the very mechanisms that were propping up the company's illusion of success. Her memo, a courageous act, was a direct plea for intervention, but it was largely ignored by top management. Around the same time, outside Enron, renowned financial journalist Bethany McLean began asking pointed questions for a Fortune magazine article. Why was Enron, so highly valued, generating such low amounts of cash? The company's explanation of its convoluted accounting only deepened her suspicions. Then came the damning public scrutiny. Analyst Jim Chanos, a short seller who had been betting against Enron for months, publicly amplified concerns, challenging the company's financial transparency and calling its business model a black box. These questions, simple yet profound, demanded answers Enron couldn't provide. The relentless questioning from analysts and journalists intensified. Enron's complex financial structures, once hailed as innovative, now became impossible to defend. The company was forced to restate earnings for the previous 5 years, acknowledging that it had overstated profits by an astonishing $586 million. This admission shattered investor confidence and confirmed the worst fears: Enron's prosperity was built on sand. The value of the stock began to plummet, triggering a crisis of liquidity as the complex web of SPEs began to unravel, exposing the billions in hidden debt they were designed to obscure. As the situation spiraled, more truth emerged. Enron had manipulated its balance sheet to hide at least $25 billion in debt through its SPEs. This massive hidden liability was the weight dragging the company down, exacerbated by declining asset values and evaporating investor trust. The financial community watched in disbelief as one of America's corporate giants was exposed as a house of cards. The true scale of the deception became horrifyingly clear. For years, Enron had presented a false image of profitability, using accounting tricks to create the illusion of success while accumulating catastrophic debt. On December 2, 2001, just months after Sharon Watkins's memo and Bethany McLean's article, Enron officially filed for Chapter 11 bankruptcy. It was, at the time, the largest corporate bankruptcy in U.S. history, a spectacular downfall that sent shockwaves across the global economy. Thousands of employees lost their jobs, their pensions, and their life savings, often invested heavily in Enron stock, which became worthless overnight. The energy titan, once a symbol of innovation and prosperity, became a stark emblem of corporate greed and catastrophic fraud. The dream had turned into a nightmare. The ripple effect of Enron's collapse quickly engulfed Arthur Andersen. The auditing firm was implicated not only for its failure to identify Enron's fraudulent accounting but also for its systematic destruction of documents related to Enron audits. This obstruction of justice charge led to Andersen's conviction in 2002. Although the conviction was later overturned by the Supreme Court on technical grounds, the damage was done. Clients abandoned the firm, and its reputation was irreparably shattered. Arthur Andersen, once a venerable Big Five accounting firm, ceased to exist, a direct casualty of the Enron scandal. The scandal triggered extensive investigations, leading to numerous indictments and convictions. Kenneth Lay, Enron's founder and former CEO, was convicted on multiple counts of fraud and conspiracy but died before sentencing. Jeffrey Skilling, former CEO, was convicted of conspiracy, fraud, insider trading, and lying to auditors, receiving a 24-year prison sentence. Andrew Fastow, the CFO and architect of the SPE schemes, pleaded guilty to 2 counts of wire and securities fraud and served 6 years. The Enron executives faced justice, but the legal battles highlighted systemic flaws. The Enron scandal, alongside other corporate failures like WorldCom, spurred a monumental legislative response. In 2002, Congress passed the Sarbanes-Oxley Act, widely known as SOX. This bipartisan law introduced sweeping reforms to corporate governance and accounting practices. SOX mandated stricter financial reporting, increased auditor independence, enhanced accountability for corporate executives, and established the Public Company Accounting Oversight Board, PCAOB, to oversee the audits of public companies. It was a direct attempt to restore public trust in the capital markets. More than 2 decades later, the Enron scandal remains a critical case study in business ethics, accounting fraud, and the perils of unchecked corporate ambition. It fundamentally reshaped the landscape of corporate America, reinforcing the need for transparency, accountability, and ethical leadership. While SOX has been criticized for its compliance costs, it undeniably strengthened investor protections and auditor oversight. Enron's story serves as a perennial warning: innovative financial instruments, when combined with greed and a lack of oversight, can lead to catastrophic consequences for companies, employees, and the broader economy.